So the total flow of credit to agriculture as a proportion of overall credit still fairly small. If you think about it from the context of how much of it is a part of agri GDP, this number of 25 lakh crores is about 50% of agri GDP. Where is the balance 50% coming from? It's still largely informal sources. So these are the puzzles that are worth considering, that why is institutional credit still not scaling up? Why do we have large skews? If you think about, 25 lakh crores is the overall number. But if you think about how that gets distributed across states, across districts, it's a totally different picture. So there are important, I would say, persistent puzzles, frictions, and a lot of my life career dedicated to thinking about these frictions. Why is non-institutional credit so high despite all of the policy regulatory work? The other sort of thing that you might not think a lot about, but we do in our work, is to say that the banks are still sort of the elephant in the room, particularly the public sector banks. Whereas if you think about where a lot of innovation has come from in financial inclusion in the last 15, 20 years, it's been non-banks. Non-banks in agriculture, minuscule, right? About 5% of financing, whereas they represent 30% of total credit in the system. Why aren't non-banks stepping up? Why aren't we seeing the kind of innovation that we saw in microfinance, in SME finance, in agriculture? You would think that's the logical place to start. But I think we really have a challenge there. And again, why do regional disparities persist? One of the policy reforms that I was involved with at RBI was to come up with this notion of adjusted priority sector lending. Some of you may be familiar with the idea of priority sector lending. It's this idea that credit must be directed to certain sectors of the country if you want a banking license, right? It's as simple as that. And we sort of propose this idea that don't make it an overall number at an all India level. If banks, financial institutions channel more of their credit to districts that have lower credit depth, lower formal sector activity, give them sort of more PSL points, as it were. So there is some activity, but I would say not nearly enough. Again, this should be familiar, but what are some of the barriers to scale? I think since 2014, if you think about it, RBI has licensed 2 new private sector banks, 10 new what we call small finance banks, which is an entirely new construct. I would say their entire raison d'etre is inclusion. Small finance banks, these were all started their life as non-profits, microfinance institutions, and were given bank licenses, and 7 payment banks. So that's quite a bit of expansion of formal sector activity. However, this has really not translated into a lot of expansion of resources, as we talked about. We all know this, but just to quickly go through it, what are some of the issues? I think as lenders, we still struggle with the fact that, at the end of the day, agriculture lending is risky. It's as much an enterprise prone to success and failure as running a shop or running a factory. But given the public policy environment in India, we are not permitted to price our risk in. So Dr. Raghuram Rajan famously talked about this concept of a grand bargain in the Indian agri-finance sort of world, which is to say, as government, I'll give you access to cheap funding, but in return, you must lend to sectors that I ask, and I might not put it down on paper as a formal interest rate cap, but the fact is you cannot get away with pricing agricultural loans for the underlying risk. So as large banks, there's always, I think, friction there. And of course, I think all of the shocks, systemic issues, which has only been growing, right, thanks to climate change, whether you talk about weather events, political risk, farm loan waivers are a big part of the political economy reality for all of us, and then supply chain disruptions. I want to talk a little bit about this concept of, as a sector, as the banking system, we are not quite doing enough in terms of designing suitable products, suitable loan contracts for the farm community. And let me give you a quick example, right? And would love to sort of just get a quick show of hands on this. Let's think about two loan products. Okay, so both, let's say to the farmer pre-harvest, 25,000 rupees of lending. One is structured as a single sort of disbursement, paid back in equated monthly installments, very nicely written down on a sheet of paper. The other product, let's say, is disbursed in multiple tranches linked to the crop cycle, right before irrigation, at some stage of planting, etc., etc. And repayments are now linked to the actual yield of the farmer, right? I often ask this in a room full of bankers, which is a better or a simpler product, A or B? Usually in the banker room, I hear A. And I think the catch is simpler for whom? Simpler for me. Because, it's easy to print out my loan repayment schedule, put it into my core banking system, etc., etc. But if you think about the role of finance, which we do, as taking away risk from those who cannot manage it well to those who can, loan B really does a much better job. Yes, it's harder to design, harder to implement, but I presume that's why we are all paid big salaries. But at the end of the day, I think just if you think about the products, the contracts that are there, bottom line, it's leaving a lot of risk in the hands of the farmer, even with current intensive farming, etc. So all of this only gets sort of exacerbated, right? And so when I think about regenerative agriculture, and I've not thought about this very deeply, but to me, it's really a specific case. The macro sort of factors remain the same, right? On the supply side, you're not going to have new institutions providing regenerative agri-finance. It's going to be the same old tired institutions. But at the farm level, now you have additional things to think about. You have an impact on the scale of finance. And because of the nature of regenerative agriculture, we may be not talking about one clean activity to finance, but it may be a mix of activities at the household level. Yields could, in the short term, fall down. And again, many of you here in the room are experts. And time horizons. Let's say we're talking about somebody who's switching from, commodities to agroforestry. It's a fundamentally different risk because of the timeline involved in payback of the project. So there's a need for new financing approaches. There's a need for new institutions. To make it come alive, very briefly, I'll share 3 examples so that it's not as abstract. First of this is from our own work. This is a company that we've created called Dvara e-Registry. Importantly, this is not a lender, but we originate credit and then sort of pass it on to the banking system. So in some sense, we are the farmer-facing kind of entity. How do we do this? We've come up with something called the Kate score, which very importantly does not use the proxies, the familiar lazy proxies of land ownership, farmer income, how long have you been cultivating this crop, etc. It's a much more first principles risk score. We use remote sensing, we use crop analytics, we use a lot of pictures of the crop progression, etc. We come up with that score. We underwrite and give loans to farmers based on our assessment of the risk. And then we tell the bank, hey, here's a portfolio of 10 crores. I guarantee the performance of this because I've underwritten this myself. Can you take this off me and give me the liquidity against it? So I think this, and there are other organizations starting to do work like this. I think it's interesting because it goes away from relying on things like land ownership and sort of vintage, which fundamentally go against sort of adoption of newer practices. Dvara e-Registry is also doing important work with FPOs, and that's, I think, an interesting emerging form of collectives in this space. Still a lot of, I think, variation in quality. However, I think it's a promising kind of platform and could play a fairly interesting role, particularly in adoption of new practices. Another example is from former colleagues of mine at ICSCI. They run a company called Arya Commodity Financing. They do something called co-lending. Again, Arya is not themselves a bank, but co-lending, very simply put, is you take a loan of 10,000 rupees. Somebody like Arya says, I will sort of underwrite 10% because I'm sort of a smaller entity. State Bank of India will take sort of 90% of the loan. So in a way, you're able to crowd in a lot more resources from the banking sector. And Arya, interestingly, works in the post-harvest space. Again, as lenders, for us, the difference in risk with and without commodity is huge, because without commodity, it's like venture capital, right? The farmer has plans, but the weather gods have other plans. It's a highly risky endeavor. But if you have commodity in the warehouse, you're simply underwriting how much commodity is there, what's the loan to value. But despite that, this has been a very, fraught space, because particularly storing at government warehouses means it's a complete black box. As a lender, I don't know commodity hai ki nahi. We once in ICICI had the terrible situation. We thought we were financing godowns full of potatoes, but we went to claim there was nothing. So Arya has sort of gone after that problem, and they're offering warehousing as a service, which in turn goes a long way in terms of mitigating post-harvest credit. Finally, a quick example around Syngenta Foundation. They've done interesting work in terms of creating a last mile network of entrepreneurs that they call agri-entrepreneurs for distribution of innovative products, climate smart agriculture inputs, but also financing. One thing I hope you take away from these three examples, and we're doing this really quickly, is that none of these examples are banks. And that's sort of one message I would love to leave the room with, is to say that if we have to make a dent in agri-financing, regenerative agri-financing, we need specialized organizations that are actually coming from the real sector, from people like yourselves, who have the reach, last mile, absolutely crucial, who have the know-how, and who have the ability to design instruments that keep the farming household in mind, rather than banks who sort of have a standard term loan that they use to finance a shop, and then they're saying, chalo, isko, we'll tweak it a little bit for the farming context. A lot of these innovative players are actually starting off as ag tech companies, and then are adding on financing along the way, which again is very promising. And I would personally really be enthusiastic about scaling organizations. I talked about 3, but there are many more like these coming up. Scaling up organizations like these, finding a way to link them back into the banking sector, rather than push the banking sector kicking and screaming into territory that they're not familiar with or don't know what to do. Before concluding, I know there are many of you interested in what role can concessional capital play, etc. Don't worry about this busy slide too much, but I will say that this is the structure we use to provide 1 lakh crore of financing to the microfinance sector in India. And the biggest innovation was, if you look at the bottom, I don't know if this is... if you look at the bottom where it says credit enhancement provider, that is a new role that we would envisage for providers of concessional capital, whether it be multilaterals, whether it's large philanthropy, etc., to say, don't come in and crowd out the domestic financing sector. There are a lot of resources there. How can you catalyze, how can you unlock funding that's already sitting right in this large Indian banking sector? So what we did in the context of microloans is to say that we created portfolios of loans. We said we want local banks, local mutual funds to participate. However, initially, players like ADB, players like IFC came in and said that we will, let's say, take care of 20% of the risk of these loans. And it is a contingent sort of statement, right? If, as a lender, I'm very confident about the performance of my loan, but the other side is not. So somebody like ADB comes in and says, I'm giving you the commitment that if 20% of these loans go bad, I will step in and refund you. So in the initial structures, we were able to, this is an illustration of something that we call securitization. But structures like these are interesting innovations that let concessional capital participate, unlock a lot of domestic, kind of flows. And over a period of time, they can then sort of peter off and take a step back, because by then there is a lot more understanding, there's a lot more data about, truly how risky is it. For example, MFIs, microfinance, I've been in room after room where people have told me that 0.5% default rate, this is too good to be true. What's the catch? So until people participate in those transactions, they see repayments, etc., investors are hard to convince. And I think that's a really interesting way for concessional capital to come in and to say that, we will work with specifically sort of that goal in mind. So that was sort of my last slide. And I will just say in closing, in the opening plenary, I thought there were, really interesting, inspiring statements around systems thinking. That's really what we need also in the financial sector. And I think it'd be amazing to see the food systems and the finance community work more closely together. And I think the message there, as Mr. Nandakumar said, is again, the key is local. We need more local financial institutions who know the customer, who know what the new viability rules are around regenerative agriculture. And then players like us, I think, have a role to then plug them back into the larger financial sector. So let me leave you with that. Thank you very much.